Money Sense, bringing an informed financial perspective to the Cayman community.
On behalf of the Board of Trustees of the Cayman Islands Chamber of Commerce Pension Plan, we share our warmest wishes for the holiday season and a happy, healthy, prosperous, and blessed new year. Thank you for your continued support and business. We look forward to serving you in the upcoming year. For information as it happens, follow us on our social media channels, Facebook, LinkedIn, and Instagram, and visit our website, chamberpension.ky. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.
Welcome to Money Sense. This is Adam Butler on behalf of the CFA Society Cayman Islands. I am here today with Alison Schrager, Senior Fellow at the Manhattan Institute, also columnist at Bloomberg, and author of a book provocatively titled An Economist Walked into a Brothel. So we're going to explore some of the themes that Alison explored in her book today, and maybe also, if we have time, touch a little bit on Alison's view on what's happening in the economy and in markets right now, and what investors should be prepared for. So, Alison, welcome to the show.
Yeah, thanks so much for having me.
Yeah, no, it's great. Just listeners, so you know, Alison is in town for the CFA Forum, delivering a presentation for us, and has kindly carved off some time to speak with us. So, Alison, maybe take us through the journey that led to you being motivated to write a book called An Economist Walked into a Brothel.
So after I finished my PhD, which is in retirement economics, I started writing for The Economist, and then I did that for a couple months, and before I met Robert Merton, the famous financial economist, and he was like, I really like your research, we should work together and figure out how to use our research to build financial models that can actually help people. I didn't know a lot of finance at the time. I was more of a macro person, although I was always very interested in risk. And so from him, we worked together for 7 years, and I learned a lot of finance, as you can imagine. Eventually, we were acquired by DFA, where I got to work with Jean Fama and Ken French, and got to know a lot more finance, particularly about fixed income. And, I kept writing with The Economist for a while, and then later moved on. But I was writing, and it felt to me like I'd acquired two very useful skills. One is a knowledge of finance and risk, and the other was I was good at communicating it. That's the thing writing and media teaches you, is how to communicate complex ideas simply. So I was really motivated to be like, what I've learned from Merton and Fama and French are just, I think, such important, powerful ideas. But they're not very accessible to a lot of people, and often not framed that way or not presented as useful. So I kind of had this idea that I would write a book because, also as a writer, and I think as an economist, it was also like time to write a book. It wasn't like I had this great, inspiration. I think that people think you have. It's more like, well, this would make sense now. But I was really like, well, what could I do that would really contribute? And I was like, I'd love to do like a Freakonomics, but for finance. Because I felt like Freakonomics really taught the world how economics isn't just, guessing what unemployment is going to be. It's actually how to make sense of the world in using this framework. And I was like, well, financial economics is a little different from applied micro, and I think actually even a lot more valuable to everyday people. So could I do that for finance? So I became clear author. I didn't have a lot of research papers because I'd done a more sort of industry-oriented career. So I decided instead I would lean on my experience as a writer and report and actually meet people. And they'd tell me their story about how different industries put a price on risk. And the hypothesis was, which did turn out to be true, thankfully, but I don't think it was that bold, was that, risk is priced in markets, and financial markets are very good at it because they have a lot of data. But the same principles apply in all markets, no matter how unusual you think they are. So I spent 2 years traveling the country and just meeting people in some really weird markets to figure out how they put a price on risk and how they manage risk, and how it pretty much conforms to everything we do in financial markets, and how these skills are so valuable and can honestly help people. Particularly, I think when we think about personal finance, we don't really teach it very well, or help people really understand that they're effectively solving a risk problem. That always seems to be lost in that conversation. So the idea was that people can help understand this, they can help understanding this through stories that they connect to that are a little bit, sexier than, although, I find financial markets endlessly fascinating. Not everyone does. How to make it more accessible to everyone.
Yeah, that's great. For those who don't know as well, as Alison sort of, rhymes off these famous names, Robert Merton, Jean Fama, and Ken French have all won the Nobel Prizes in economics. So, these are very famous people within Alison's profession. And so amazing that you had a chance to learn under them for so long. And so you mentioned that your book sort of explores how risk is priced in a variety of different, maybe non-traditional markets or domains that most people maybe wouldn't think about there being a market in, right? So maybe first of all, what does it mean risk is priced for our listeners? What does that mean? And then what are some of the non-traditional domains that you explored where you found that in fact risk continued to be priced in a very intuitive way?
Well, something I think even people who work in financial services often lose sight of is I think it's the most fundamental basic rule of finance, which is, effectively no risk, no reward. It's just, I think it's like, other than like the denial of death, I don't think there's anything more human to be in denial of. And I think people always think they can get a high reward for no risk. And I think that's honestly where people always get ripped off. And when people get nervous about finance, is forgetting that there's this trade-off is just ironclad. So when you think about generalizing that to other areas, it's just, if you take more risk, you'll get a lower price, right? Like risk-free assets are more expensive than risky assets. And it's so simple, and it pretty much undergirds all of financial markets. And yet it's like very smart people seem to completely forget about it all the time. So I think what you find in other markets too is sort of riskier transactions end up, as I said, being a little cheaper. You get a discount if you take more risk in a transaction. Or if you want more security, you do have to pay for it if you want more certainty. And that was true in the set for sex work. I spent like 2 months following around the paparazzi. I spent time with big wave surfers, and you just see this everywhere. It's just not always obvious to people, but that is just sort of this fundamental truth.
Yeah, so, I guess this translates to maybe domains that people touch more often. Mm-hmm. We expect stocks over the long term to deliver higher returns than bonds because stocks typically, you're taking on more risk when you buy stocks, right?
Exactly.
And longer term bonds are expected to deliver higher returns over time than shorter term bonds because you're locking up your money for longer and therefore there's more uncertainty or risk. That's sort of the theory behind it, right?
Exactly. Except private equity is sort of proving us wrong on that one, but I still think we're going to be redeemed.
I agree with you. So great. So how do we translate this idea of higher risk should engender higher payoff? Maybe walk us through a couple of the more interesting domains that you explored in a little bit more detail. Maybe start with either the surfers or the brothels, your choice.
So in the brothel, what I did is I went to the Nevada brothels and surveyed all the women on what they charge.
Why Nevada?
Because that's where legal sex work exists in America. Other than, I guess in Nevada and other countries, they also have it. But it's the only place in America where you can sell sex legally. And so I was able to compare that. This economist, I guess it scraped data. The illegal sex market, more or less all the matching and occurs online. And there's also sort of very explicit, shall we say, reviews of the transactions that occur. And an economist I know scraped all that data. So I had 1.1 million observations of illegal sex transactions going back to like 1999. So I could really put a price on the illegal sex market for different services. So then I went, but the illegal market's quite risky. There's disease, there's violence for both sides of the transaction, there's the threat of law enforcement. All around is a very risky job. But the legal market is actually quite risk-free in terms of, as I said, selling sex. It's totally legal. Sex workers, you don't have to pay taxes. Even for the client too, he knows what he's getting. He knows he's not going to face any repercussions or law enforcement. And as I said, there's no scope for violence. There's good security there. Everyone's screened for STDs. I mean, it is as close to risk-free as you can get. So my hypothesis is that this would cost more, and it did. There's actually a 300% markup. I found for the most common transaction in the brothel it was $1,000 an hour, but a similar transaction for a similar amount of time in the legal market was about $300.
Incredible. Wow. And then big wave surfers, I think, is a really interesting story as well.
Yeah. So it turns out that they're just like us. And once a year, they have a risk conference where they, I'm not kidding, sit in like a windowless conference room in a hotel. And like if they're wearing board shorts and like flip-flops and like they're better looking than us. But, you know, but they have a discussion about risk. And I mean, for them, the discussion was more, and I think this is something we're all grappling with, is how the interaction between technology and risk. Because technology certainly enables us to sort of have more options for insurance and hedging like we never did, and it should in principle make the world less risky. But on the other hand, it also can empower us to take risks. So I actually met this man named Brian Kulana, who I like to think of as like the Robert Merton of big wave surfing, and that he was the one who brought jet skis to big wave surfing. And jet skis really do play a similar role to stock options in markets, and that they were brought in as insurance, right? In the way an option's an insurance against, you know, a price falling too low or too high. Jet skis were supposed to be, if you wipe out surfing, this is a different way to be rescued. Because, you know, when the waves get choppy, you can always get a lifeguard swim in. So he was a lifeguard, and he had this realization that he could rescue people if he was on a jet ski that he before would let drown. So he's the one who brought jet skis to big wave surfing. And it was wonderful. But then, after a couple of years, the surfers were like, hey, we could use this to get on bigger waves. So they actually were able to be pushed. So before the big wave community, maybe you get on 20, maybe a 30-foot wave on a good day. Because I mean, the big waves travel faster, and there's only so fast, you know, you can paddle. But then they notice if they use these jet skis, they can be put on even bigger waves. And that's why when you see these pictures of people surfing 90-foot waves in Portugal, they were put there by a jet ski. Like, you just couldn't get on it otherwise. So you think it's just like a stock option in that it's insurance, but it is actually literally leverage, too, if you flip it around and use it the other way. So just like a finance conference, you know, there was a lot of like consternation about this. It's just like, what are we doing? Are we being responsible? How should we manage this risk? And of course, me being an economist, even like a fairly free market one, I was like, well, you know, I mean, it seems like if you're concerned about these externalities and people not pricing them in, that you should maybe think about regulation. And they didn't care for that.
That's great. I mean, it's just like, I think people could connect intuitively the introduction of seatbelts. Mm-hmm. Well, yes, it in theory makes roads more safe, but also it makes people feel like they can drive faster on the highway.
Yeah, this is what we call the Peltzman effect.
The Peltzman effect, right.
Although he makes that argument, although I think the data does show that we are safer on the road. Like, you're a lot less likely to die in a car accident than you used to.
Right.
And I tend to be a techno-optimist, so I think on balance, we are better off from these things, but there are downsides you have to be aware of. And I think certainly, like, in the world going forward and with all the changes we're facing from technology, that's the thing we have to be mindful of.
Yeah, well, that's a great place to end this first half of the show. We're going to take a quick break and then come right back for the second half of Money Sense with Alison Schrager. Stay tuned.
On behalf of the Board of Trustees of the Cayman Islands Chamber of Commerce Pension Plan, we share our warmest wishes for the holiday season and a happy, healthy, prosperous, and blessed new year. Thank you for your continued support and business. We look forward to serving you in the upcoming year. For information as it happens, follow us on our social media channels, Facebook, LinkedIn, and Instagram, and visit our website, chamberpension.ky. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.
Money Sense, the only personal finance radio show in the Cayman Islands, hosted by Simon Caudry from the CFA Society Cayman Islands.
This is Money Sense.
Okay, welcome back to Money Sense. This is Adam Butler on behalf of the CFA Society. I'm here with Alison Schrager, Senior Fellow at the Manhattan Institute and author of the book, An Economist Walked into a Brothel. And we spent the first segment discussing some of the primary research and interesting stories that she had to share from one it went into the first book. And I understand from Alison that she's currently writing a new book. I wanted to dig into some of the themes that she's hoping to explore in this one. So maybe just share with us, what is this new book and what are the core topics that you're hoping to discuss?
Well, it's actually 7 myths about risk that we get wrong. One of them, I thought about one of them actually being no risk, no reward, how we always mess that up. But in the end, I decided against to do things a little bit more counterintuitively. So it's 7 myths about risk. And pretty much these myths sort of explain, I think, 2 phenomenon that I think we don't get enough attention. One is that the world is a lot of ways getting less risky. I mean, we just face so much less severe downside risk than we ever have before. And people always want to feel like things are getting worse. And, I think that's human. I think there's evolutionary reasons why we want to always feel that way, but it's just not true. In some ways, we've never had more potential for upside and less downside risk than ever before. But despite that, it seems like we're also getting more and more risk averse. And so the book sort of explores like why we're becoming more risk averse. In this environment where we have more upside than before, and sort of what the consequences are for that, and hopefully how we can break out of that.
Great. So can you give us some examples of what makes you think that there is both less risk in the world today and that people are more risk averse?
Well, I mean, I said we see the statistics, like I was saying, even about cars. It's, we drive more miles than ever before, but the odds of dying in a car accident, COVID different because people drove a little recklessly then, have never been lower, just because we do have all of these safety features because cars are so much better. So, I mean, that's just one. I mean, and, other than, recently as well, we did have sort of increasing life expectancy. I mean, I usually like to go back to finance as sort of my touchstone, but an example would be corporate bonds. Less risk of default, which is sort of like the worst case scenario, but also in some ways a wider range of things that could happen, most of it to the upside. So, my opening story for that, not quite as exciting as a brothel, is I found this man in Alaska who is the last homesteader, still alive, got the last homestead patent. And, he's a baby boomer and was just like, I don't want this Southern Californian suburban lifestyle I was handed. I'm going to homestead in Alaska. And he got the last patent. And, you tell people this story. I think it's cool because I love Alaska. And they're just like, that guy sounds crazy. And you think about what homesteading was and how it used to be this program where the government said, take this crazy risk. And, if it works out, you'll get rich. Otherwise, you might die. But, go for it. And, we used to sort of valorize these people. And now we're sort of like, you're crazy. And I was thinking about even how I found this guy was sort of, I think, shows how we've evolved. I mean, we evolved from people homesteading to homesteading being this sort of freaky thing to even how I found him, I think shows how we're evolving. The summer I was in college, I actually spent in Alaska at selling incense, as you do. But back then, that wouldn't have been weird. It wouldn't have been weird that you're a college student, even if you're sort of ambitious in life, that you sort of took this ferry up the Inside Passage, and I met all these other young people. We're all sort of like, we'll just see what happens this summer, and we'll get jobs, and, it'll be cool. And, most of them worked in the fishing industry. I ended up working for this hippie. And, we just sort of were up this adventure. Then we went to fairly, I guess, normal lives. But you just kind of had that was that last bit of American adventure. We did it for a summer, but it was a summer. And now I'm told that that just doesn't happen anymore. That college kids don't just sort of come up without everything arranged. And if they do, they're not working. They tend to do enrichment programs, so they either learn about marine life or Native American life or whatever, but it's a pre-planned program where they get college credit and, everything's arranged for them. So they don't even have that little bit of summer. So it was sort of, to me, illustrative of how much we've changed in terms of risk. That we went from homesteaders to this baby boomer homesteader to me just doing it for a summer to not even that.
Yeah, I mean, it sounds like an extension of the phenomenon of the helicopter parent, too, and how it's no longer acceptable or normative for children to just go out and play and then, come back after dark or what have you, right? It's, society seems to have a lot higher priority on each individual human life but also not allow for the uncertainty and adventure that allows humans to flourish and and grow and, become, right?
Yeah, I mean, there's no doubt that this is we are safer, and that is a wonderful triumph over, chaos and misery that humans have lived with. But, you wonder if we've just now gone too far.
Right.
I hate to dunk on young people today because ultimately they were helicoptered parent by us. So, you see it's a long running trend, and they're just sort of taken it to a new extreme. So, this has been going on for a long time, and it's not really their fault. But I worry, the book sort of gets into sort of what we're seeing, which is we shouldn't be surprised that so many people have stagnating wages. That, the economy of productivity isn't what it was because, risk are important elements of that. Risk is an important element of growth. And if you take that away from people, I think it not only might be contributing to sort of less mental well-being, but also stagnation in people's lives, certainly economically, which I think, we're trying to figure out how to get around that. And I feel like our answers are completely wrong because we're trying to all right, let's take more risk away from people instead of thinking, how can we empower people to take more risks? But also we are a richer society, and sort of falling through the cracks, I agree, is completely unacceptable. So how can we think about ensuring people to empower them to take more risks, but also make sure that they have some protection? And I don't think that's a conversation we're having. We're let's just take away more risk.
Yeah, right. It's we chatted a little bit about this yesterday. There's sort of two sides to the social safety net. And one is that this sort of UBI aspect where you give a certain minimum income to each person, and then they turn around and are able to do whatever they want with it. The other side of it, and that's kind of the income side, but there's an insurance side that may be more empowering. Maybe walk us through how you think about that.
Because you think about what we know about finance. Again, finance should always be our touchstone to figure out the world, is my thought. There's two ways to manage risk, mainly hedging and insurance, right? So hedging is just de-risking. It's taking less risk, and you give up upside for that, but you end up with more safety. And there's also insurance where you sort of make sure you don't have too much downside, but you keep all the upside. And when I hear about things that we're doing a lot more hedging. UBI is effectively hedging. It's all right, we're going to have, I assume, higher taxes to pay for it, but we're also going to have sort of this guarantee. So it's effectively a hedge, which we know reduces risk, as opposed to, I think we could think a little bit more cleverly about insurance. UBI is by definition not insurance. People seem to confuse it, and I see a lot of the studies on UBI confusing it. By definition, it is unconditional, and you get it no matter what happens, as opposed to insurance only pays off if something happens. So you'd think something like that would be better at empowering people, particularly low-income people, to take risk.
Yeah, right. As opposed to, for example, disentangling health insurance from employment.
Yeah.
Or raising the floor on unemployment insurance so that people have an opportunity, they have enough resources available to be able to move to a new market where there may be a new job opportunity. These types of policy recommendations, very different in terms of how they empower or incentivize people to behave versus UBI.
Well, and I think it's notable that you point that out because we had an experiment with that with the pandemic. Certainly there's room to criticize some of the pandemic economic response, but you also did empower people a lot. They did have this huge insurance program where they got quite a bit of money, and we saw things we hadn't seen in a long time. We saw people moving for the first time in years, and moving rates had lowered. We saw a big uptick in entrepreneurship that is still going. So in a lot of ways, as I said, sort of this insurance program that did pay off in a bad time empowered a lot of risk-taking. Anyway, it was actually a quite scary time for a lot of people.
Yeah, right. So if we're a society that has decided that we are going to allow governments to manage the risk of the business cycle, risk of upticks in the unemployment rate, manage the risk of a major downturn in markets, for example, what do you think that implies for the expected returns on investments going forward?
Well, it could go a bunch of ways. On the one hand, some people argue that you can't ever really manage these risks. I agree with that, but I think you can take the edge off them. I think that's what we should be thinking more than we're going to just tame the business cycle all the way. I think policymakers can only really sort of make it less bad and sort of help the most needy when things go badly. So on the one hand, if you feel like this is a fool's errand, in some ways we're going to end up with sort of, in the end, sort of bigger, worse recessions, because when it comes crashing down, it will really become crashing down. The other alternative is that this is really expensive, and you can't. I remember after the financial crisis going to the OECD, and everyone was like, "This is proven that cycles are intolerable, and we need sort of less volatile cycles." And this it was France. They're like, "Our way is the best way." But I think what people don't realize is you do give up upside. As I said, there's this central truth to finance. It's so simple, yet it's so sophisticated, and it shows up everywhere, and no one wants to see it. That if you're saying we're going to tame the business cycle, or we're going to have less volatility, then that means we also are going to have less growth. And maybe that's okay. Maybe we've decided we've grown enough. Personally, I don't. I like to think we have unlimited potential, and humans can always do more. But I think we have to be sort of comfortable with that trade-off.
Yeah, right. So how do you see that manifesting? I mean, let's sort of touch on your other daily role as a Bloomberg columnist. How are you seeing some of these dynamics playing out in markets at present? Is there anything that you can point to that is aligned with some of the conclusions or research that you did in the book?
Certainly, I think we're seeing it everywhere. As I said, I think people have I was talking to someone about the maturity wall. And this is this big concern that if rates stay high for too long, then, we haven't seen a lot of defaults yet, but because people were able to lock in rates for a couple of years, in the next year or two, or 3 years, particularly in 5 years, people might have to refinance at a higher rate, and that's going to be a problem and could lead to some serious dislocations. But I was talking to a friend of mine who's a NPR and economic correspondent, and we were both kind of like, I don't think the government's going to let it happen. I think there could be a bailout. And I don't think that's unreasonable to expect. But it also sort of says to me that I think the problem is that risk prices don't have much meaning anymore. And when that's happening, risk distortions sort of show up all over the place. And I think that worries me. And so at best, we'll just end up with lower growth. At worst, we could just end up with big blowups down the road.
Yeah, there's also a strange incentive misalignment that certainly manifested after the 2008 bailouts. But it does seem as though those who were the least prudent in a classical sense, who took the greatest risk, who took on the most leverage, who extended their lifestyle as far as possible beyond their income, have been the ones that have made out the most over the last decade or so.
Yeah, and there's an entitlement to it. I just wrote a column that's going to come out in the next couple of days about the gold rush. People for a while thought, I go to finance, I'll get rich quick. And then it became tech. And now with higher rates, tech is on the way out. And I was reading this essay by this tech entrepreneur who created a company that employs people and has value. It's just not transforming the economy. So he's not going to become a gazillionaire. And he's quite upset about this. And it's sort of well, you didn't transform the economy. Why would you become a gazillionaire? Becoming a gazillionaire should be a very rare thing. You've got to be like Elon Musk to do that. But, and what struck me reading it is how disconnected he was from risk. He felt entitled to become a gazillionaire. He never took any risk. He never put up his own capital. He never went without a paycheck. And it's sort of he's talking about this money as if it was free. And it reminded me of 2008 because I'm but it wasn't free. This is pensioners' money. Where did you think the VC money came from? Who do you think the LPs are? And by and large, they're public pensions. And so this isn't just money that people could just play with. It was, but it shouldn't have been.
Yeah.
And I don't think we've really, I don't know how the industry and how that's all going to shake out. But, as I said, you don't make the risk go away. It's so far removed from that fireman that I don't think people really look at these tech entrepreneurs who were blowing money on whatever. And some didn't. I think a lot of value was created in those years, but a lot wasn't.
Great. Well, we're going to have to leave it there, Alison, because we're out of time. But thank you so much for coming in and sharing your great stories about the research for your book. And best of luck with your talk.
Thank you.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.
On behalf of the Board of Trustees of the Cayman Islands Chamber of Commerce Pension Plan, we share our warmest wishes for the holiday season and a happy, healthy, prosperous, and blessed new year. Thank you for your continued support and business. We look forward to serving you in the upcoming year. For information as it happens, follow us on our social media channels, Facebook, LinkedIn, and Instagram, and visit our website, chamberpension.ky. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.